Hello and welcome to the lecture for part 2 of chapter 1. In this part, I'm going to talk about the 4 different financial statements in a bit more detail. And one thing I'd recommend that you do is take a look at the extra practice spreadsheet that I put on Moodle for you, where you'll go through 3 different companies and chart the transactions in the transaction grid and create the financial statements. So I've posted both a blank spreadsheet for you to do those 3 companies, and I'll post the solution as well to that. So please, that'll help kind of cement what I talk about in this particular area. So first thing we're going to talk about is the balance sheet. The balance sheet mirrors the accounting equation. So it's going to show all of the assets that the company owns and then all of the claims on those assets. So the liabilities and the stockholders' equity, and confirm that they equal each other. Everything on the balance sheet is recorded at historical cost, or what we paid for it. So it's not, if we get an appraisal on the land that shows it's worth more money, we don't increase the value of that. A balance sheet is recorded as of a point in time. So it's standing on the, say, midnight of December 31st, if they're a calendar year-end company, and saying at that moment in time, it's kind of like a picture of the company. At that moment in time, what do we own, what do we owe other people, and what do the owners claim to the business? So in terms of formatting, the assets are listed in order of liquidity. So what is closest to cash? So cash will come first, something like land will come last. And the balances carry over from one year to the other. If I end year one and I have $50,000 in cash and I have $100,000 in land, well, that is what I start the next year at, because I still have that cash, I still have that land. So the balance carries forward. And I use a balance sheet, and people use balance sheets, determine the financial health of an entity. So is it safe to loan them money? I'll look at what are their liabilities compared to their assets to try to determine that. So here's a transaction grid that picks up where the transaction grid left off that we covered in the previous lecture. So the previous lecture showed the events for year one. Now we're in year two. So notice my beginning balance, 51,000 in cash, 500,000 in land, and so forth. That equals what my ending balance was at year one. So we carried all those things forward. So transaction one, we acquired 32,000 cash by issuing common stock. So when cash comes into the business, cash is going to increase. So transaction one, cash goes up by 32,000, and my common stock goes up by 32,000. So the equation stays balanced. At transaction two, we receive 116,000 cash for providing services to customers. So that's revenue. Revenue pulls up retained earnings, so cash increases because cash comes into the company, and retained earnings increases. And we note that it's due to revenues. Transaction three, we paid 62,000 cash for operating expenses. So now cash is leaving the business, so cash decreases, and retained earnings decrease. Revenues pull retained earnings up, expenses pull it down. We paid 9,000 cash dividend to owners, so cash again is leaving the business, so cash decreases and retained earnings decreases, not because it's an expense, but because we're sharing some of those earnings with the owners of the company. We're not retaining them in the business. Next, we sold land that cost 200,000 for 200,000 cash. So we didn't have a gain or a loss, so that would have impacted retained earnings, but that didn't happen. We sold it at break even. So cash is going to go up. We're receiving cash. Land goes down because we have less land now. Then the last transaction, we paid 300,000 cash to pay off a portion of our note payable. So again, cash is leaving the business, so cash decreases, and the note payable decreases. That's an asset use transaction. Both sides go down. And then I total my columns. So I've got 28,000 in cash, 300,000 in land, got 100,000 remaining payable on my note payable, got 152,000 in common stock, and 76,000 in retained earnings. So I'm going to check before I do anything else and add up both sides and make sure they equal each other. So I can do that quickly, and I see I've got 328,000 on both sides of the equal sign, so I know I'm in balance, and I can take the next step and do some financial statements. So the balance sheet for the company is just going to be those totals from the bottom of the columns. So you can see for year one, I have the totals from the worksheet that the transaction grid that we did in the previous lecture. And for year two, I've got the totals there, the 28,000 in cash, the 300,000 in land. And you can see I have a total of 328,000 in assets. And when I add up my note payable and my liability and my stockholders' equity, I have 328,000 on that side. So those two numbers have to equal each other. If they don't equal each other, then you've made a mistake somewhere and you need to find that before you move on. So the income statement is revenues minus expenses. That tells us what our net income is. So if it's positive, we have net income. Revenues are greater than expenses. If it's negative, we have a net loss. So in that case, expenses were greater than revenues. So whereas the balance sheet was at a moment in time, kind of a picture of the company, the income statement is like a movie. It's what happened over a period of time. And it could be for a month, a quarter, a year, but we'll need to specify what the period of time is. And we do our best to try to match expenses. Actually, I've got a typo there. It should say match expenses with their related revenues. I'll have to fix that. Sorry about that. And keep in mind that net income isn't the same as cash flow necessarily, and we'll get into that more in Chapter 2. So in this particular company, remember we had $116,000 in revenues and $62,000 in expenses. So for the income statement for this company, and note the header there, the name of the company, what it is we're looking at, and the period of time that's in question. So this is for the year ended December 31st, year two. So I had 116 of revenue, 62,000 of expenses, so I had 54,000 in net income. The next one we'll do is the statement of changes in stockholders' equity, and that reconciles beginning and ending stockholders' equity. Remember, stockholders' equity increases with revenues, decreases with expenses. So in other words, net income is going to increase it. Investments in the company are going to increase this category. And net losses and distributions of profit or net income will reduce it. Okay. So it is, again, like the income statement, it's a movie that covers a period of time. So we have to say what period of time is relevant here. And I just mentioned how it's increased and decreased. So let's take a look at that. So again, I've got a proper header there so we know what it is we're looking at. So this company had beginning common stock of 120. They issued another 32. So the ending common stock was 152. And then they had beginning retained earnings of 31,000. We add net income of 54 to that. That came from our income statement. And we subtract the dividend of 9,000, so our ending retained earnings was 76,000. They add up together to 228. The last thing I want to talk about is the statement of cash flows. So the statement of cash flows records all of the inflows of cash and all of the outflows of cash that happen during a period. So again, during a month, during a quarter, during a year. We categorize those in three different categories. One is operating activities. So that's what did we do for the main purpose of our business. If that's consulting, it's what inflows came in as a result of our consulting activities and what outflows occurred as a result of our operating activities, our consulting. If we're selling physical products, it's the same thing. It's what happened relative to those physical products. So it's the core of our business, what we're in business to do, what happened for that. Investing looks at what happened cash flow wise for buying and selling long-term assets. So did we buy some land? Did we sell a building? Did we buy a building? Did we buy a truck? Did we sell a computer? Those kinds of things. And then financing looks at what happens relative to long-term debt and equity in the company. So did we borrow money or did we pay off our debt? Did we have investors put more money into the company for ownership, or did we disperse some money to them for dividends? So the way that's going to look is I'll have receipts and inflows for all of those different activities. So the finished statement is going to say, what were my cash flows from operating activities? We got receipts from customers and we paid out expenses. So we had a net of $54,000 that came in for operating activities. For investing activities, the only thing that happened was we got money for selling land. So we had a net cash inflow for investing activities. For financing activities, we received some cash for issuing stock. We paid cash out for dividends to the owners, and we paid cash out to reduce our long-term debt. So cash flowed out of the company for financing to the tune of $277,000. Now, when I add up those three numbers, I get negative $23,000. So my cash balance decreased by $23,000 during the course of the year. So I add that to my beginning cash balance and I reconcile it to my ending cash balance. I could go back and look at the balance sheet and confirm that I ended at $28,000. So the information this provides is you might look at this company and say, wow, their cash went down by $23,000. That's not good. Well, let's look a little bit deeper. What happened here? For the core purpose of this company, which is renting out campsites, they generated $54,000 in cash. They generated another $200,000 by selling land they didn't need. And what did they do with that money? They paid back their shareholders some money and they reduced their debt. So this is overall a very good picture. Okay. So the last thing I want to talk about is the articulation of the statements. And this is kind of a little bit of a confusing graphic, but we'll always start with the income statement first. So we'll always, when doing financial statements, start with the income statement. Revenues minus expenses is net income. Why do we start with the income statement? Because we need that net income figure in order to do the second statement, which is a statement of changes in stockholders' equity. Net income is a component of that. So I do that second statement. I do the statement of changes in stockholders' equity. I do that second because I need the ending stockholders' equity for my balance sheet. So I do the balance sheet last or third, and then last I'll do the statement of cash flow. So I do the balance sheet, again, my assets, liabilities, stockholders' equity. When that balances, I've completed the primary three financial statements. So we'll practice this on 3 separate companies. I'll post the solutions to those, and I'll also post a video of working through the practice problems that will help you for your homework for assignment 2, which is due on Wednesday of next week. Well, thank you very much.